You've probably heard the financial term PE ratio, or price to earnings ratio. What this means is how much money does each dollar of earnings cost me? So as an investor, if there's a PE of 5, it means I'm willing to invest $5 for every $1 of earnings. Some companies have really high PE ratios and some companies have low PE ratios. Is a high PE ratio good? Is it bad? Well, it depends. When a company has a high PE ratio, investors have really high expectations for the company. They're willing to pay a huge premium on earnings because they expect a lot more earnings in the future. One extreme example of this is Tesla once had a PE ratio of 1200, which means I'm spending $1,200 for every dollar of earnings. The problem with some PE ratios is they are priced for perfection. So if I'm spending over $1,000 for a dollar of earnings, things have to go perfectly. Sometimes a high PE ratio isn't a bad thing. For example, Amazon once had a PE ratio of $3,000. $3,000 for each dollar of earnings. This was deliberate. Amazon chose to reinvest their earnings in the business. So the high PE ratio wasn't because the stock price was out of control relative to the earnings. It was because the denominator, the earnings, was quite small because Amazon was reinvesting it in the business. CrowdStrike's PE ratio hovers between $300 and $500 per dollar. Palantir's PE ratio hovers between $150 and $250 per dollar of earnings. PE ratio can be a useful way to compare apples to apples. Company A is worth $100 a share. Company B is worth $200 a share. If Company A has a PE ratio of 3,000, you're paying $3,000 for every dollar of earnings. If Company B, remember, $200 a share, has a PE ratio of 50, you're paying $50 for every dollar of earnings. So Company B is less expensive than Company A. There are other ratios that can be useful, like PS, or price to sales ratio. How many dollars am I willing to spend for each dollar of sales? Maybe the PE ratio is really high, but maybe the PS ratio is pretty low. I'm paying a pretty low amount of money relative to their sales, the revenue that they're generating. And there's another metric, my favorite metric, which is price to free cash flow. That ratio says, how many dollars am I willing to spend for every dollar of free cash flow, which is the ultimate bottom line for a company. If a company has a really high price to earnings ratio and a really high price to free cash flow ratio, that's a problem. It means you're spending a lot of money for each dollar of earnings and you're spending a lot of money for each dollar of cash. There's another ratio called price to book ratio, which says if the company goes bankrupt and liquidates their assets, how much cash can that generate? And for some industries like banks or rental car companies or airlines, they have a lot of physical stuff, airplanes, cars, that they can sell if they go bankrupt. For software companies, price to book is not very useful because they don't own a lot of stuff. There's another ratio called EBITDA, earnings before interest, taxes, depreciation, and amortization. And EBITDA says, what are the raw earnings that this business generates before they start to change things? Because if I'm a private equity firm, I'm going to come in and I'm going to have my own strategy for taxes. I'm going to have my own way of structuring the debt. That's something I can change. The problem with EBITDA is that those strategies say something about how the company operates. If they're a company that depreciates things over a ridiculous amount of time, or if they're a company that pays really high interest on their debt, that context matters. There are many different ways to value a company, and you can't just look at the stock price. You have to look at the full picture.